$580 million moved 15 minutes before a presidential announcement. And that was just the opening act. What happened inside the COMEX silver market last week makes that trade look like a warm-up. One institution, 800 contracts closed near the exact price bottom. 38 million ounces delivered into an ETF simultaneously. Same entity, two moves, opposite directions, perfect timing. This is not speculation. This is in the exchange's own official data. I'm Marcus Caldwell, independent market analyst, and this channel reads primary sources exclusively. The CME Group Daily Delivery Notices Report, the CFTC Bank Participation Data, the Sprott Money Institutional Framework, AI Invest's December Analysis. Every number I give you today is verifiable in under 30 seconds. The institution at the center of this analysis paid $922 million in federal fines. Its traders were sentenced by a federal judge in August 2023. And between June and October 2025, it executed what may be the most consequential position flip in COMEX silver history. That institution is JPMorgan. And it just made another move. Before I walk you through exactly what that move means, if this level of market intelligence is useful to you, hit subscribe and turn on notifications. This channel exists to give you the institutional-grade analysis that most retail investors never see. Your subscription directly supports independent financial research. Now let's follow the delivery data, move by move. Move 1. The position flip that rewrote the rules of the game. For years, JPMorgan held the largest silver short position in COMEX history. That short position is what the $922 million CFTC fine was built on. Between June and October 2025, according to multiple independent institutional sources, JPMorgan closed that entire 200 million ounce paper short and used the freed capital to acquire physical silver. The result is a position that has never existed before in the modern era of COMEX trading. 750 million ounces of physical silver. 40% of COMEX silver futures contracts. A valuation of over $40 billion. To put that in historical context, no single entity has typically held more than 10 to 15% of any major commodity futures market. JPMorgan is sitting at 40%. The institution that spent 15 years controlling silver's downside is now positioned to control its upside. That is not a minor market development. That is a structural regime change. Move 2, January 7th, and the delivery report that nobody talked about. On January 7th, 2026, JPMorgan issued 99% of 8.1 million ounces in a single day's delivery notices. That's 1,624 contracts from one institution in a single session. What made this extraordinary was not just the volume. It was what happened to open interest simultaneously. January, open interest increased by 1,431 contracts despite those deliveries. In a normal market, large deliveries reduce open interest. Contracts get settled, inventory moves, positions close. Here, open interest rose while deliveries were being issued. That means traders were rolling contracts backward from March into January and February to take immediate physical delivery rather than wait. Urgent demand for physical metal is the only explanation for that pattern. And JPMorgan was the entity supplying 99% of it. Move 3. 800 contracts and 38 million ounces in the same week. This is the move that the mainstream financial press completely missed. During the most extreme silver price correction of the entire cycle, the crash from $95 to $60, JPMorgan closed more than 800 silver contracts near the exact market bottom. Simultaneously, 38 million ounces of silver were delivered into the SLV ETF. Same institution, same week, opposite directions. 3 analytical interpretations exist for this dual move. Interpretation 1. JPMorgan is distributing physical silver into SLV's custodial vault at the price floor, reducing physical exposure while maintaining full paper long exposure for the recovery. It profits on the paper position, while SLV shareholders who bought shares on the dip now own the physical that went in. Interpretation 2. JPMorgan is building inventory ahead of an anticipated retail and institutional inflow wave into SLV. When investors accumulate SLV shares on the recovery, the ETF needs physical silver to back those shares. The 38 million ounces going in now are the strategic inventory built before demand arrives. Interpretation 3. JPMorgan is managing its regulatory posture. Under the December 22, 2025 CFTC consent judgment. Closing paper contracts near the bottom and delivering physical into the custodial ETF. It demonstrates responsible position management to compliance monitors. All three interpretations are consistent with the delivery data. None can be proven from public filings alone, and that honest limitation matters. Here is the most important caveat in this entire analysis, and I'm giving it to you directly because this channel does not sensationalize. Craig Hemke at Sprott Money published this on December 23, 2025. All reports regarding JPMorgan closing their short position are ultimately speculation. The CFTC does not disclose specific bank positions. No institution announces its strategy. What we have is delivery data, warehouse reports, and ETF custody filings. Analytical reconstruction, not confirmed disclosure. The January 7th 99% issuance figure is confirmed from the CME's own daily delivery report. The 750 million ounce physical position is reconstructed from multiple data sources. The strategic intent behind every move on this board is, as Hemke put it, accumulated experience producing assumptions that cannot rise to declarative statements. Carry that with you. Move 4, the regulatory dimension that could change everything. In 1980, the Hunt brothers held a concentrated long position in silver. The CFTC and CME invoked Silver Rule 7, switching the market to liquidation-only trading. The corner attempt collapsed. Silver crashed from $50 to $11 in a matter of weeks. That regulatory response is the specific historical precedent that every position limit rule currently governing COMEX was built on. On March 12, 2026, the CME updated position limit rules 559, 560, and 562. Two versions of those rules appear simultaneously on the CME website. One effective through March 11th. One effective March 12th. The critical question for every investor in this market is whether those new rules tighten JPMorgan's ability to maintain 40% of COMEX futures, or whether the hedging exemptions that currently create the regulatory gray area remain intact. If regulators move against the position, forced unwinding creates downside volatility. If the hedging exemptions hold, JPMorgan's mark-to-market gain, at every price above its acquisition cost, becomes the most powerful structural tailwind silver has seen in modern market history. The March 27th CFTC Commitment of Traders Report is the first document that begins to answer that question. There is also a fourth dimension that this analysis cannot ignore. JPMorgan leased physical silver to ICBC, the world's largest bank by assets, in a 3-month arrangement scheduled to return in January 2026. The same January where JPMorgan issued 99% of delivery notices. The same January where 49.4 million ounces were delivered, 7 times the prior January level. Whether ICBC returned that leased silver into a market experiencing acute physical delivery stress, or whether the lease was extended or restructured, is a question the public filings do not answer. But the delivery volume anomaly in January is confirmed, and the timing alignment is documented. Here is what to watch and when. Watch the CME Daily Delivery Notices report at cmegroup.com for the April delivery cycle beginning in late March. Whether JPMorgan continues as dominant issuer or changes its issuance profile is the first signal of whether the 800 contract closure near the bottom was strategic reduction or routine management. Watch the CFTC Commitment of Traders report at cftc.gov, published Friday at 3:30 Eastern. The Bank Participation Report component shows aggregate U.S. bank net positions in silver futures. A significant reduction in that aggregate number suggests large institutional silver exposure is coming down. Watch SLV daily holdings at iShares.com. If the 38 million ounces reported going into SLV are confirmed in the ETF's daily update, the custodial delivery mechanism JPMorgan controls as authorized participant is actively operating. Watch the monthly CFTC Bank Participation Report for any change in the number of U.S. banks reporting net long positions above the reporting threshold. That specific change would indicate whether the JPMorgan position is being distributed across the banking system or concentrated further. JPMorgan flipped from the largest silver short in COMEX history to holding 750 million ounces of physical and 40% of futures contracts. It issued 99% of January delivery notices on the 7th. It closed 800 contracts near the exact price bottom, while delivering 38 million ounces into SLV simultaneously. And the CME updated its position limit rules on March 12, 2026. The Grandmaster's game is in progress. The delivery data is confirmed. The strategic intent is, by the honest assessment of the most rigorous analysts in this space, educated inference from primary source reconstruction. Friday at 3:30 Eastern, the federal government publishes the next move on the board. If this analysis gave you an edge today, like this video, share it with one person who needs to see it, and I'll see you at 3:30 on Friday.